So, in response to China's recent economic troubles, the central bank is making moves to respond. So, let's see what the CNN article has to say about this. China's central bank is cutting interest rates by stealth. Central banks around the world are cutting interest rates to head off recession. China is now joining them, but in a roundabout way. On Saturday, the People's Bank of China launched a long-awaited reform to the way it manages money, in the world's second biggest economy, to support growth and employment. Its aim is to make it cheaper and easier for companies to borrow. Sounds like a rate cut. The central bank is gradually replacing its existing fixed benchmark lending rate with a new long prime rate, starting Tuesday. The idea is that the new fluctuating LPR will better reflect changes in market rates. China's new loan prime rate amounts to a rate cut, Pantheon Macroeconomics said in a research note Monday. The Chinese economy has slumped to its slowest pace of growth in nearly 3 decades. Because of a range of factors, unsustainable debt levels, and transition from heavy industry and infrastructure to consumption, and the escalating trade war with the United States. Yeah, China has like a really big real estate bubble that they have to deal with. But that's another topic that I don't think they're going to mention in detail here. China's interest rate system has long been criticized for failing to pass on lower rates to borrowers in the corporate sector. Chinese banks prefer to lend to state-backed companies because of the lower risk. That means the private sector, which has been hit hardest by economic slowdown in the trade war, is usually underserved by credit. The PPOC's benchmark one-year lending rate stands at 4.3%. It hasn't changed since October 2015. The new LPR will be set Tuesday, and subsequently on the 20th of each month, it will become the benchmark for banks to price new loans. The reform indicates the central bank is trying to tackle a more fundamental issue, making it easier for lower rates to pass through to corporate borrowers, said Hao Zhao, senior China economist for Commerzbank in Singapore. Ken Chuan Kin Tai, chief Asian foreign exchange strategist for Mizuho Bank in Hong Kong, described the reform as a bold step. He said it showed the Chinese central bank wants to join the global easing camp, especially after recent disappointing economic data. News of the change boosted Chinese markets. Hong Kong's Hang Seng Index staged its biggest rally in 2 months, gaining 2.2%. The Shanghai Composite Index also ended up 2.1%, its strongest gain in several weeks. So, China's central bank is trying to ease things up too, just like a lot of other central banks in response to the global slowdown. Markets will be watching closely on Tuesday to determine the magnitude of the economic boost, Chuang added. Analysts said it was too early to say how effective the monetary policy overhaul would prove, but added that the PBOC had good reason not to opt for cutting its benchmark lending rate. It wouldn't lower borrowing costs effectively, it could stoke fear about a downturn. The authorities probably don't want to garner too much attention, especially at a time when the slowdown is already worse than expected, said Vincent Chen, managing director and head of China equity strategy at Credit Suisse in Hong Kong. In the current political climate, Beijing would be particularly cautious, he added. This is because mounting stability is a key task ahead of the 70th anniversary of the founding of the People's Republic of China on October 3rd. So it's a particularly politically sensitive time because the 70th anniversary is coming up, and they want things to run especially smoothly. So I guess they're finding this backdoor way as a roundabout tactic for easing rates, even though their official rate isn't technically being lowered. Policymakers have already responded to the economic slowdown with a range of measures this year. The latest came on Friday, when China's top economic planning body announced initiatives to boost spending, including increasing people's disposable income, stabilizing employment, and speeding up reforms in rural areas. The Chinese central bank also has a rich policy toolkit to manage the supply of money. In recent years, for example, it has cut the reserve requirement ratio, encouraging banks to lend more. The PBOC hasn't said when the existing benchmark lending rate will finally be scrapped, but it reiterated Saturday that it wants to merge its system of fixed and floating rates. So China is trying to find ways to stimulate the economy in response to a worsening slowdown. Please share this video, like, comment, subscribe, and hit the notification bell.